Welcome to today's lesson, where we'll be discussing the basics of each investment type and the importance of researching specific investments. In this video, we'll cover what stocks, bonds, mutual funds, and real estate represent, the mechanics of how each investment works, the potential risks and returns associated with each type of investment, the importance of diversifying a portfolio. So, whether you're a seasoned investor or just starting out, this section is a must-watch. Let's dive in and learn about the basics of each investment type. Stocks, also known as equities or shares, represent ownership in a corporation. When an individual or institution buys a stock, they are buying a small piece of the company and become a shareholder. As a shareholder, they have the right to vote on certain corporate matters, such as the election of the board of directors, and they may also be entitled to a portion of the company's profits, known as dividends. When a company issues stocks, it raises capital that it can use to invest in its business, such as building new factories, hiring employees, and developing new products. In return for this capital, the company gives up a small portion of ownership and shares some of its future profits with the shareholders. The value of a stock is determined by the market, and it is influenced by a variety of factors such as the company's financial performance, the overall economic conditions, and the sentiment of investors. The price of a stock can fluctuate daily, and it can increase or decrease based on changes in these factors. Stock analysis is the process of evaluating a stock in order to make informed investment decisions. The goal of stock analysis is to understand a stock's characteristics, financial performance, growth prospects, and risk. One key component of stock analysis is reviewing the company's financial statements, such as the balance sheet, income statement, and cash flow statement. This information can provide insight into the company's revenue, expenses, profits, assets, liabilities, and cash flow, which can be used to evaluate the company's financial performance and position. Another important aspect of stock analysis is reviewing the company's management, competitive position, and industry trends. This includes an assessment of the company's leadership and management team, its competitive advantage and positioning in the market, as well as the industry and macroeconomic trends that may impact its performance. Stock analysis is significant because it allows investors and portfolio managers to make informed decisions about which stocks to invest in and how much to allocate to each stock. By understanding a stock's characteristics, financial performance, growth prospects, and risk, investors and portfolio managers can make more informed decisions about the potential risk and return of each investment. It's important to note that stock analysis is an ongoing process, and it's essential to keep track of a stock's performance over time and reevaluate the investment thesis as new information becomes available. Stock analysis should be used in conjunction with other investment strategies and tools, such as technical analysis and market research, to make well-informed decisions. Bonds are debt securities issued by companies or governments to raise capital. When an individual or institution buys a bond, they are lending money to the issuer in exchange for the promise of regular interest payments and the return of the principal amount at the bond's maturity date. The bond issuer is obligated to make these payments, regardless of its financial performance. Bonds are typically considered to be less risky than stocks because they provide a fixed income stream and the return of principal at maturity. The value of a bond is primarily determined by its coupon rate, the interest rate paid on the bond, and the prevailing market interest rates. If the market interest rates rise, the value of existing bonds will fall, and if the market interest rates fall, the value of existing bonds will rise. Bonds are valuable because they provide a source of steady income and can help to diversify a portfolio. They also have the potential to provide a more stable return than stocks, which are subject to market fluctuations. Bonds can be used to manage portfolio risk, as they tend to perform differently than stocks in different market conditions. Investors can choose from a variety of bond types, such as treasury bonds, municipal bonds, corporate bonds, and high-yield bonds. Each type of bond has its own set of risks and potential returns. For example, treasury bonds are considered to be among the safest bonds, while high-yield bonds, also known as junk bonds, carry higher risk but also offer higher returns. A mutual fund is a type of investment vehicle that pools money from a large number of investors to purchase a diversified portfolio of securities, such as stocks, bonds, and other assets. The fund is managed by professional money managers who use the pooled money to buy and sell securities in accordance with the fund's investment objective. When an investor buys shares in a mutual fund, they are buying a small portion of the fund's overall portfolio. The value of their investment will fluctuate along with the value of the underlying securities in the fund. Investors can buy and sell shares in the mutual fund on a daily basis, and the value of their shares will be based on the net asset value of the fund, which is calculated at the end of each trading day. An advantage of mutual funds is that they offer investors the opportunity to diversify their portfolio with a relatively small amount of money. By investing in a mutual fund, investors can gain exposure to a wide variety of securities and sectors, which can help to reduce the overall risk of the portfolio. Mutual funds provide professional management, which is especially useful for investors who do not have the time, expertise, or resources to manage their own portfolio. Mutual funds also typically have lower investment minimums than other types of investment vehicles, such as hedge funds, making them accessible to a wider range of investors. However, it's important to note that mutual funds come with management fees and expense ratios, which can eat into returns. Therefore, investors should carefully review the fees and expenses associated with a fund before investing. Real estate refers to the ownership or use of land and any buildings or structures on it. Real estate can be an attractive investment for a variety of reasons, including the potential for rental income, appreciation of property values, and tax benefits. There are several types of real estate investments, including residential properties, commercial properties, and industrial properties. Residential properties include single-family homes, apartments, and condominiums, while commercial properties include office buildings, retail centers, and warehouses. Industrial properties include manufacturing facilities and storage buildings. Real estate investments can be made through direct ownership of property or through indirect ownership through a real estate investment trust, REIT, or a real estate mutual fund. Direct ownership allows investors to have control over the property and its management, while indirect ownership provides the benefits of diversification and professional management. Real estate can provide a steady stream of income through rental income, and the potential for appreciation of property values over time. Real estate investments can provide tax benefits, such as deductions for mortgage interest and depreciation. However, it's important to note that real estate investments can be complex and involve significant risks. The value of real estate can be affected by a variety of factors, including economic conditions, interest rates, and changes in local real estate markets. Owning real estate properties can require significant time and resources to manage, and the value of the property can be affected by natural disasters, economic downturns, and other events. Researching specific investments is an important step in the investment and portfolio management process. It helps investors to make informed decisions about which investments to include in their portfolio and how much to allocate to each investment. Company analysis. Researching specific stocks includes evaluating the financial health and performance of the underlying company. This can include analyzing financial statements, such as the income statement, balance sheet, and cash flow statement, to assess a company's profitability, liquidity, and solvency. Additionally, it's important to research the company's management team, industry trends, and competition. Bond analysis. Researching specific bonds includes evaluating the creditworthiness of the issuer and the terms of the bond. This can include researching the issuer's credit rating, financial statements, and the bond's coupon rate, maturity date, and call provisions. Mutual fund and ETF analysis. Researching specific mutual funds or exchange-traded funds, ETFs, includes evaluating the fund's management, expense ratio, and performance. It's important to also research the fund's holdings and the industries or sectors it invests in to understand the fund's investment objective, which tells you what type of investments it holds and what its goals are. Real estate analysis. Researching specific real estate investments includes evaluating the property's location, condition, and potential for appreciation or income. It's important to research the local real estate market, including the current supply and demand for properties, as well as any upcoming developments or trends that could affect the value of the property. Tax considerations. Researching specific investments also includes understanding the tax implications of the investment. This includes understanding the tax treatment of any dividends, interest, or capital gains that the investment generates and whether the investment is held in a tax-advantaged account. We'll talk more in depth later in the lesson. Company analysis is the process of evaluating a company's financial and operational performance in order to make informed investment decisions. The goal of company analysis is to understand a company's strengths and weaknesses, as well as its growth prospects and potential risks. There are several key components of company analysis, including an examination of a company's financial statements, such as the balance sheet, income statement, and cash flow statement. These statements provide information on the company's revenue, expenses, profits, assets, liabilities, and cash flow, which can be used to evaluate the company's financial performance and position. In addition to financial statement analysis, company analysis also includes an examination of the company's management, competitive position, and industry trends. This includes an assessment of the company's leadership and management team, its competitive advantage and positioning in the market, as well as the industry and macroeconomic trends that may impact its performance. Company analysis is important because it allows investors and portfolio managers to make informed decisions about which companies to invest in and how much to allocate to each company. By understanding a company's financial performance, management, competitive position, and industry trends, investors and portfolio managers can make more informed decisions about the potential risk and return of each investment. It's important to note that company analysis is an ongoing process, and it's essential to keep track of a company's performance over time and reevaluate the investment thesis as new information becomes available. Additionally, company analysis should be used in conjunction with other investment strategies and tools, such as technical analysis and market research, to make well-informed decisions. Bond analysis is the process of evaluating the creditworthiness and risk of a bond in order to make informed investment decisions. The goal of bond analysis is to understand a bond's characteristics and potential return, as well as its risks. There are several key components of bond analysis, including an examination of a bond's credit rating, yield, maturity, and coupon rate. Credit rating agencies such as Moody's and S&P provide credit ratings, which are an assessment of the bond issuer's ability to meet its financial obligations. Bond analysis also includes an examination of the bond issuer, such as the company or government agency that issued the bond. This includes an assessment of the issuer's financial health, management, and industry trends, which can impact the bond's creditworthiness and risk. Yield, maturity, and coupon rate are also important factors to consider when analyzing a bond. Yield is the rate of return on the bond, which is determined by the coupon rate, the interest rate paid on the bond, and the bond's price. Maturity is the date on which the bond will reach its full face value, and coupon rate is the interest rate paid on the bond. Bond analysis allows investors and portfolio managers to make informed decisions about which bonds to invest in and how much to allocate to each bond. By understanding a bond's creditworthiness and risk, investors and portfolio managers can make more informed decisions about the potential risk and return of each investment. It's important to note that bond analysis is an ongoing process, and it's essential to keep track of a bond's performance over time and reevaluate the investment thesis as new information becomes available. Additionally, bond analysis should be used in conjunction with other investment strategies and tools, such as macroeconomic analysis and market research, to make well-informed decisions. Mutual fund and ETF analysis is the process of evaluating a mutual fund or ETF in order to make informed investment decisions. The goal of mutual fund and ETF analysis is to understand a fund's or ETF's characteristics, portfolio composition, performance, and risk. One key component of mutual fund and ETF analysis is reviewing the fund's or ETF's portfolio composition, which includes the types of securities it holds, the industries and sectors it's invested in, and its overall diversification. This information can provide insight into the fund's or ETF's investment strategy and risk profile. Another important aspect of mutual fund and ETF analysis is reviewing the fund's or ETF's performance, which includes its historical returns, volatility, and risk-adjusted returns. This information can provide insight into the fund's or ETF's past performance, and its ability to generate returns in different market conditions. Additionally, it's important to review the fund's or ETF's expense ratio, which is the annual fee the fund or ETF charges to cover its operating expenses. A lower expense ratio can indicate a more cost-effective investment option. Another important aspect of mutual fund and ETF analysis is to review the fund's or ETF's management. Knowing the fund's or ETF's management team and their track record can provide insight into the investment strategy and decision-making process of the fund or ETF. Real estate analysis is the process of evaluating a real estate property or portfolio of properties in order to make informed investment decisions. The goal of real estate analysis is to understand a property's or properties' characteristics, financial performance, growth prospects, and risk. One key component of real estate analysis is reviewing the property's or properties' physical characteristics, such as location, age, size, condition, and amenities. This information can provide insight into the property's or properties' value, potential rental income, and future development prospects. Another important aspect of real estate analysis is reviewing the property's or properties' financial performance, which includes rental income, operating expenses, cash flow, and return on investment. This information can provide insight into the property's or properties' current and potential financial performance, and help to identify any potential risks or opportunities. The real estate market analysis is also important to review the real estate market trends, such as supply and demand, economic conditions, and demographic trends. Finally, this information can provide insight into the properties or property's long-term growth prospects and potential for appreciation. Thanks for watching. Let us know what you would like to see next.